Hello and good morning, everyone. Welcome back to Eldercare's training series, Eldercare Academy. I am Adrienne.
And I'm Candy.
And we are super excited about today's topic. I know I'm personally going to be learning a lot and taking notes, especially with Candy's questions. So hopefully everyone has their pen and paper, are going to be taking notes, but also this is recorded. So if you are watching the recording on YouTube, you can comment your questions there too. We're always following up on our YouTube. And if you're watching live this morning on Zoom, it's the Q&A box.
And we want you to chat with us while we're talking. If you have a question, throw it in there.
Yes. Yeah. And the chat box is disabled. I know that gets really confusing with Zoom.
Yeah.
But it's the Q&A box. If you'll let us know, are you currently writing annuities? Do you know what FIA stands for?
I want to throw that out there.
I want to know who I'm talking to this morning for sure. And if you're on Facebook Live in our private group, just comment and we will get your questions answered. But do you want to introduce our special guest?
I'll let you.
You're going to let me?
Yeah, I'm going to let you.
Okay. Well, this morning we have Vito, such a cool name, with Allianz, which is also a fun name to say. Good morning, Vito, and welcome.
Good morning. Thank you for having me today.
Absolutely. Thank you for taking the time to talk to our brokers. I know that there's a lot happening in the Medicare industry. And I know that these agents on here mostly do Medicare. So they have Medicare clients, which I hear are the ideal client for the products you're about to talk about.
And I will say this too. The world of Medicare is changing. It has been ever changing lately. Mm-hmm. And so agents are looking for lots of different products. And this is a great opportunity to go in and say, hey, here's something that might help you with your growth.
Absolutely. Good point. Good point. Well, I'm going to, the biggest compliment we get, Vito, in our trainings is we get to the point. So I'm going to let you take over.
Fantastic. And yeah, I know we've got a bit of an action-packed agenda. We're going to talk through FIAs. I'm stealing the answer for you guys. Fixed indexed annuities today. We're going to start with our top two selling. These are industry-wide top two sellers across all FIAs. So very popular solutions. Next, we're going to kick over to our accumulation-focused solutions. And as you mentioned, Medicare can be a fantastic segue. You're doing a lot of the discovery of why you might need a fixed indexed annuity, some of the more deep levels of financial planning. Our income side is going to be that guaranteed income for life. Great for that protection on an older client. We don't want all their assets maybe at risk in the market. We've got sequence of returns risk. We've got volatility, interest rate risk. This can be a great way to offshore some of that, get a guaranteed lifetime income stream, or maybe just protect the money. Maybe we want to pass it on to our beneficiaries. A lot of flexibility between these products. But here are the top two products we have on the shelves. And the first two we're going to be going over today. Got the 222, industry number one seller of all time. About 5 years back, we launched our ABC, or Allianz Benefit Control Annuity. Now it's the second best of all time. It's been creeping up pretty quickly to our 222 here.
Best of all time, second best of all time.
Yeah, so we've got the popular ones here, and I'll make sure to touch on why our products are a little bit more nuanced in the industry, why people like to go to us for maybe a longevity purpose. But back in May of last year, we actually revamped all of our income solutions. So we've increased the flexibility to take free withdrawals on these products. We've got new crediting methods. I know people who do know a lot more about FIAs have probably heard volatility controlled indices, excess return indices. We've tried to narrow that down, give people more options, but maybe less complicated ones at the same time. So we know exactly what we're getting into. And then our income flex capability, which we won't be going over today. It does get pretty deep into the weeds, but another way to allow more liquidity for a client who needs their lifetime income or might have a what-if scenario, taking a vacation, a medical expense that's unexpected. A lot of built-in features to both of these products. We're going to start out with our 222 Plus annuity. So we call this the income later product. I also think of this as our perfect legacy product. I'll show you why, as we have some bonuses to these products. For people who maybe want to just pass on their money to beneficiaries, you're going to see some pretty great option here. So the 222 is the name. It's also an acronym. The first two is 2 ways to receive a bonus. Day one in the policy, we actually have a limited time promotion going on. But day one, you get a 45% premium bonus for any money the client puts in. That's actually 52 right now until June 15th for anybody who is looking for a bonus legacy product here. The other way to get a bonus is our 150% interest factor. We're going to look at an example of what both of these mean to break it down with some numbers. The second two is 2 ways to get an income increase. So once the client turns on their lifetime income, with us, we do things a bit differently, and we always guarantee potential for increasing income. And we do that on top of your interest credits. Maybe you're allocated to an S&P, something of that nature. We'll give you whatever that performance is times 1.5 to continue to grow your income, but it increase, try to keep up with inflation, rising cost of healthcare, concerns with taxes. And then lastly, our income multiplier benefit, second way to get an income increase there. The last two is probably the most popular of this product. The beneficiaries can receive a death benefit in 2 ways. They could take a lump sum of the accumulation value, get the money out right away. Otherwise, they can take what we call protected income value. Some companies call it a benefit bonus or a benefit rider, but you can take that over a 5-year period. And that's going to be the more fruitful, inclusive of bonus money, and why it's very popular for passing on to a legacy in this product. We won't spend too much time on the nitty gritty details of these products, but typically what you're going to see with us is an issue age of 0 to 80 and $20,000 to initially start a policy. People will often ask how long you can add funds to these policies. It is 18 months or a year and a half. So once the policy issues, you have that much time to add any additional funds that might come due. And then 10% free withdrawals available after the first year. So if a client maybe is not using this for income, but still wants to take a free withdrawal, they do have that capability as well, just to get some liquidity back. Now, I want to show how these bonuses work in tandem with each other so that makes a bit more sense and why this is very popular as a legacy product. So again, right now, limited time, it's 52%, but we'll use a 45% bonus for our example here. If a client puts in $100,000 on day one, the left side of the equation is showing that $100,000 in your accumulation value. On the benefit base or protected income value side, that's where our bonus money comes into play. So $100,000 day one is shown on the income side of this equation as $145,000. That's an immediate $45,000 extra dollars for a beneficiary to receive, or once they turn their lifetime income on, we would base it off of this higher value on the right side. Now, on top of getting a day one bonus, this is that second bonus that comes into play every single year, as long as you're getting interest credits on your allocations. So after our first year in this hypothetical, we get a 3% return. Your accumulation value would get the full 3%, growing at $103,000. But that right side of the equation, the protected income value, that's where our 150% bonus factor comes into play. So 3% is really treated like 4.5%. And that's going to grow that income-based side or your death benefit money even stronger, even faster, of course, compounding every single year as well. If we have a negative or a 0, it's just going to be reflected as a 0 for the client that year, as we are fully downside protected. These are also fee and charge free products, so you won't see any reductions there. In our next example, year 3 at 3.5% can get you up to 5.25% in the return, strictly on that income value side. So I would say that the focus for this product is income down the road. It is at least a 10-year hold to turn on income, or using for that legacy play. So if we do have some additional funds sitting on the sidelines that we know the client might not need to use, this can be a great product that offers the flexibility of income later if we need it, or that legacy money to pass on to our beneficiaries.
Is there a max on the money that can be dumped in there?
There is not. And I guess an example I'll give is we did have last year one case get approved and go through for $32 million.
Okay.
We do have large case review at $2 million and higher. And those are pretty rare to have a very large case of that stature. But yeah, we're very flexible. And there's no reduction on commission for those higher policies, as well as you'll commonly run into with other carriers.
Okay.
Great question.
Good
Anything
sign.
else? Yeah, it's good. Anything else come in question wise I should address?
No, not yet.
Nope. And hopefully everyone can hear and see as everyone's probably paying really close attention. So must be anything coming through the Q&A.
That's
but I'd
perfect.
be curious to see like Caroline, Crystal, John,
Shirley,
Naomi. What are you guys thinking?
I can take a hit or two, absolutely, too. If you have that feedback for me, let me know. But this is a good segue into our ABC annuity here. So again, started with the 222. It's been on the shelves a long time, and most common feedback we got is, hey, this is a great product for these benefit features, but clients don't always have a long time horizon, like 10 years to turn on income. We might need it immediately. We might think we need it in 10 years and something happens 5 years from now where we need it now. That was
So
the
the other
inception.
products, it's 10 years before you're able. Okay. Thank you.
Correct. At least a 10-year deferral for income.
Okay.
And that's why we built the ABC annuity, or Allianz benefit control. Was just put on the 222 chassis, but with some additional features. And this one has a lot more income flexibility. So as well as standing for Allianz benefit control, it's also another acronym here. A standing for anytime income. So instead of waiting 10 years, we can turn income on immediately as long as the client's 50 years old or older. You can also turn it on at any month anniversary. So a lot of contracts are going to be anniversary to anniversary basis. But if we're 7 months in and that's when income's needed, you let us know and we'll start income right away. The B standing for benefit control. So what I always say is you're getting a give and a take, of course, with any product. With this product, you're getting a 25% premium bonus. The last one's 52 currently. The reason you're getting a lower bonus is because you're also getting a lot more flexibility of when you can turn income on. So from a pricing standpoint, that's your give and take. We also have what we call a balanced and an accelerated interest bonus. I'll break down exactly what those two mean separately. C standing for cost of living. And I'll do a little bit of a touch base here on increasing income at the end of this slideshow so you know exactly what I mean by that. But we really do build these products for income down the road, not being the highest maybe level income that you'll see in the industry. So when you look at a side-by-side on year one, we're not usually going to be the highest, but when you look cumulatively through the life expectancy of a client, that's typically where we can win out.
Is this product more for your older ages or for younger ages?
I would say this product is typically for maybe slightly older ages. It does still work pretty well with young because I'll show you the bonus that we have in tandem when you're deferring income can really grow very strong and very quickly. But this one does have a bit more of that immediacy to it as well with the flexibility. So I think maybe a client who's around age 60, maybe wants to retire around 65, this could be a good option for them.
Okay.
Side by side here, this product is extremely similar to the 222 annuity. The one nuance I want to point out here is going to be the bottom right, that death benefit column. So if we are using one of these two products for legacy and you're deciding which one to use, I'd say typically the 222 is better. You have an uncapped protected income value that the beneficiaries can take. This product does have limitations to it. So you're always getting the lesser of the protected income value or 250% of the accumulation value when the client passes. So don't need to know all the nitty gritty, but there is limitations to the death benefit on this product, which makes it a lot more focused on a income standpoint. Now I want to talk about the two bonuses that we have associated with this product here. This first bonus is called the balanced. Second option is called accelerated. The balance is exactly what we just saw in the 222, that last product there. So if you remember my example, we had a 3% return. That became a 4.5% return. Your accumulation value got that full credit at exactly what it was. 3% was 3%. When we're deferring income, we have an accelerated bonus that you also have the option to use, and it's where a vast majority of our clients in income deferral are currently at in their policies. What accelerated does instead, you're only getting a half credit to your accumulation value. So that same 3% would only be 1.5%. But on the income side, you're getting 250% return. So 3% is really going to be 7.5%. So very strong, very aggressive way to grow your income base. Really make it the most fruitful for when you decide to turn on that income stream. We'll look at a couple numbers examples just to put these side by side. But as long as we're deferring income, you have the option to choose between balanced or accelerated at any anniversary. So you can always change back and forth. And then once we've made our decision at the next anniversary, that's where you could change it, but you'll get your credit at whatever you chose at the previous anniversary. Again, most of our products or most of our clients are in the accelerated choice as they really want to grow that income base for down the line. So just to put some numbers behind this, balanced and accelerated, we're both using $100,000, and we're going to use the same example of a 4% return. If we chose balanced, again, just like the 222, we'd get a 4% return to our accumulation value. We would get a 6% return to our protected income value. On the flip side, if we had been in the accelerated option that year, that same 4% return is only going to give you 2% or $2,000 on the accumulation value side, but a modest 4% return will actually be a 10% return on that protected income value side. So as long as we are focused on taking income from this product, the accelerated option is going to much more aggressively, again, grow that income pool.
Is there any risk associated with the accelerated versus the balance?
The only quote unquote risk I would say is if you think this client has a chance of not using the income and maybe they're going to surrender it after the 10th year, because at that point, you're only getting half credits to your accumulation value. So if you do sit down with a client and they say, I bought this for income, but my needs have changed, I might not need this income, I would suggest flicking it back to the balanced option. That way they can at least get some growth in their accumulation value. And when they do decide to surrender it after the 10th year, they have a bigger value to walk away with.
Okay.
That's a good point. And then last thing I want to talk about here is going to be our income multiplier benefit in terms of products. Much more common now throughout the industry to have an income multiplier benefit. How ours works is on the ABC, it's available after the 5th contract year. On the 222, it's available after the 10th, as you can't turn on income until the 10th year with that product anyway. And with it, we'll double your income payments in one of two situations: confinement. The client is confined for, I believe, 90 out of 120 consecutive days, they are eligible. Otherwise, if they're unable to perform at least 2 of 6 activities of daily living or ADLs. And if we are using a joint income scenario, it can be either spouse who qualifies to get the benefits doubled for both. That benefit's going to double until one of two things happen: the client recovers, or the accumulation value is completely depleted and runs to zero. At that point, we'll go back to our regularly scheduled income payments.
Okay. I have a lot of agents who look for long-term care solutions. And, this is a great way, not necessarily to help provide for the long-term care. This is a great way to have something sitting there in case of it is needed, for the long-term care, and still have accumulation happening.
Exactly. And it can be a nice bridge the gap point too for a lot of people who just need it for maybe a shorter duration.
Yes.
Perfect. That's everything on the ABC and 222. I'll flip over to our accumulation suite after the increasing income piece here, but just want to point this out, as this is really why people choose Allianz time and time again. It's not necessarily for that first income payment. It's what we do throughout the life of the contract. So the light blue bar, that's our first year's income. The red or pink lines, those are inclusive of our accumulation value. So as you can see in year 18, the accumulation value is hit zero. The dark blue is going to be the bar of our increasing income. So how much it's increased over time. We're using a hypothetical 3% return over the duration of this averaged out. Once the accumulation value hits zero on our products, we continue to offer increasing income. We also continue to offer the 150% interest factor bonus. So you're still getting the bonus, you're still getting income increases. This is where we're very nuanced in the industry. Typically, when the accumulation value runs to zero, the client's income payments are going to be level for the rest of their life. We're a firm believer in inflation, which is why we're a firm believer in increasing income. And that's why when your accumulation value runs out, we still will guarantee, no matter how long the client lives thereafter, to increase their income, as long as they're getting performance in their indices. It's one thing to say it, it's another thing to show it. So we did an actual look back of about 60,000 in-force policies here. We found that 95% have received some form of an increase. 41% have received an increase every single year. Some of these just started a year ago, but some have been in force for 16 years. And then those who had multiple opportunities, 86% have received more than one. So not only is it possible, it's actually working out very nicely for us. And my argument is always, you can change these stats to your personal book of business to 100%. If you even just put a small portion in the fixed interest account, you'll never have a zero conversation. Your client will always get increasing income. You can still use the other funds to use in our index strategies to maybe try and get more aggressive growth.
To spread that around in different products. Is that what you're saying?
Yeah, the different allocation pools. Absolutely.
Okay.
Perfect. I'm going to switch over to our accumulation suite here. Do we have any questions popping in while I transition this?
Not yet. No. No. I don't see any questions coming through yet.
Awesome. It's either going really good or really bad then. That's what we
No,
know for
you're
sure.
good. You're doing a great job.
Kidding. I appreciate that. Well, now we're going to switch gears here. We're going to talk about our our accumulation solutions. So these ones are not going to have an income rider associated with them. They're really there for downside protection. Some people will also use them as for what we call maybe bucket planning. This maybe is their now income bucket. They're going to put money in and take 10% free withdrawals, while their other money in other funds is going to grow at the same time. They can take from that bucket later. So that's a typical use case for this product or these products. Another is going to be inherited IRA capabilities. Those can get quite confusing. And usually you have a 10-year rule to get your money out of them. This is a great way to get some growth when you inherit some money from a family member, and then you can take your 10% free withdrawals to make sure you're following the IRS rules and getting it out in a timely manner. So a couple nuance, but typical use cases we're seeing with these products here. Now, I know we're typically here to talk about our top two. The way we have our slides set up, I am going to talk about three, but really focused on the Accumulation Advantage 5 more on our shorter term solutions. So that one just came out about 2 months ago. It's been extremely popular already. It's our shortest step into the short-term accumulation products. So those tend to be quite popular, especially with clients who maybe have used a CD or MIGA in the last few years. Maybe they want to insure themselves a little bit less interest rate risk. You can use these products as a longer duration way to protect your money, get some growth in the meantime as well. But the Accumulation Advantage 5-year surrender schedule again, and it's got a lot of equity-faced options. So there's not a lot of complicated story to this one. It's going to be using indexes like the S&P 500, the NASDAQ, the Russell, names that are pretty common place with clients. They might know them as well. And very simple and straightforward design. So it's really just a 5-year growth product. You also get your 10% free withdrawals, of course, after the first year.
Do we have minimums?
Yes, these products both have a minimum of $20,000.
Okay.
And while I'm pointing that out, these are also our only two products that issue up to age 85. So if we do have an older client who still needs protection and growth, these can be good solutions too. Now, I'll talk about our trigger options. We have our equity options in caps, and we also have them in triggers. So for those who don't know how a trigger allocation might work, it's two possible outcomes. It's a very simple story. If the index is exactly flat after 1 year or positive even a penny, the client will get whatever the declared trigger rate is. Our example is 5%. If the index performs above, they're still going to get the declared trigger at 5%. So you're either getting all or nothing, because outcome 2, if we get a negative return year over year, that's going to be reflected as a 0. So we can downside protect and just get nothing for the return. The stat I like to show is the bottom left there. From a 2003 to 2023 look back, the S&P trigger would have hit 80% of the time. So it's a very simple story to put in front of a client and say you're either getting your full trigger or you're not. Tends to work out, at least historically. Now, one other one I just want to point out here very quickly, for those who are using FIAs, you've probably got some attrition from a lot of the convoluted, more complicated indices that a lot of these carriers are coming out with. It can be really hard to understand what they are. The S&P Futures Index has been very popular for that reason, as it's extremely simplistic. There's no bond component to it. It's really just tracking 3-month futures on the S&P 500, and we offer it in a participation rate. So it's an uncapped way to participate within the S&P 500. And it also has our index lock capability, which we won't really dive into today, but we'll let you lock in gains as long as it's positive at any point in time. So a lot of flexibility and control that we give back to the agents and clients is using our index lock feature. We'll take a quick peek at the rates here. This one has a fixed interest at 4.5. Again, 5-year vestibule, no fees or charges associated with it. An S&P cap at 9.5. And that S&P futures I mentioned is a 65% participation rate. So matching 65% of what the S&P 500 does, at least futures based, with the ability to use our index lock feature. 7 is going to be quite similar. S&P cap at 8.75 and a fixed at 4.4. So just a little bit less on the longer duration on this one. Now, the way we have our slides broken out here, there's 3 10-year products we have on the docket. I'm only focused on this far right one here, the Accumulation Advantage Plus. We launched this product about 1.5 years ago, and it's by far and away our top-selling accumulation solution. What people like about it is there's a bonus truly to the accumulation value on this product that a lot of people like. Whether you have a client who has had market loss recently or just wants guaranteed growth in their money, you can put $100,000 in today and immediately it'll be $115,000. Does have a 10-year vesting schedule, but it shows up in your account day one. You can take free withdrawals off of it, and the indexes are performing off of your higher money. So it's already compounding and working for you immediately within the policy. Beyond
So
that,
you do not, you can't withdraw though from it until after the 18 months. Is that what I'm understanding?
you can't withdraw from it until after the first 12 months.
12 months. Okay.
Yeah, but that's a good point. You can add premium to it for the first 18.
Okay.
And free withdrawals available after the first year.
Okay.
On this product. Yep. And so our 10% free withdrawals work a bit differently, and this is why a lot of people like it who do like to draw down from these policies. Our 10% free withdrawals are either based on the higher of accumulation value or the premium that you initially put in. So in this case, the money grew from 100,000 to 104. Now we have 10,400 available as our free withdrawal. If we dropped below that initial 100,000, let's say now they're at $80,000, they can still take the full $10,000 free withdrawal since that's the initial premium they put in. So it does offer a lot of consistency. Even as you're taking money out of this policy, you still have the full flexibility to take from the pool that you initially drew from or started with. The other way our 10% free withdrawal works is going to be a carryover provision. So let's say we didn't take that 10% free withdrawal in year 2. We now have a 20% free withdrawal that we can take in year 3. It will always be capped off at 20%, so we couldn't carry this over again to 30%. But again, another way to take some additional flexibility within these policies.
You don't have to take the full 20% though, do you?
You do not. You could just take 1%, 5%, anything in between.
Okay.
Another thing people will do too is in year 2, they might take a 5% free withdrawal. The other 5% carries over into year 3 as well at a 15% withdrawal rate. So very nice and flexible there. And I won't spend any additional time on the indices today as they can get very nitty gritty, but we do have a lot of index options that are fully participation rate, which we find to be more popular because you're not capping yourself off on a strategy. So our Bloomberg there in the middle, that one is not a volatility controlled index. It's going to be equities or cash. And then our blended futures is a set 60-40, 40% bonds, 60% in equities. Again, fully participation rate with our index lock feature. We also offer something called our highest daily value. So what this is going to do is from point A to point B, a year-to-year annual point-to-point, no matter what happens from the beginning to end, we'll always give the client the highest value at market close at any point during that year. So in this scenario, market closed at 1060 one day. Client's getting that peak without having to do anything. So for those who maybe have a little bit of allocation choosing attrition, want to make sure the client's getting the best of the best, you can also use our 1-year highest daily value to ensure that's working for you. Now, I don't think we have too much time to go into our index lock capability. So I'll just mention we have this feature. Essentially what it allows you to do is see the index performance. If it's positive at all, you or the client can call into Allianz or go to our website. You can lock the performance in the middle of a year and get your return at the next anniversary. So you're not always at the mercy of a point-to-point. If we're up 10% in the middle of the year, you have that flexibility to lock it in there and reallocate at the next anniversary. All right, I blew through a lot of information there. I'll kind of keep this cheat sheet up for a second here, but any questions for me at this point?
I don't see any coming through on the Facebook group, but it looks like Rodney is asking, which product does Vito recommend for someone taking RMDs but still wants their value to grow?
That is a good question. Well, I can't make a specific recommendation, we'll say. One I would maybe look towards is going to be actually that Accumulation Advantage Plus. With that one, you're getting your 15%, of course, day one.
Mm-hmm.
But then you're also being able to allocate with a very robust lineup of equity options. So with this one, you can still take your scheduled RMDs every single year. We are very RMD friendly at Allianz. So even if you need an RMD year one, we don't treat that as a free withdrawal. You're allowed to take your RMD without a chargeback to the agent. And then as well as taking your RMD, now you're also getting growth every single year. You can diversify between a lot of our allocation choices, but you're also getting that 15% guaranteed growth day one. So great way to maybe start out on the right foot when taking RMDs out of a policy.
I'm going to throw some kind of marketing question at you. I'm head of the, digital marketing. So do you have like good marketing pieces agents can use, or like something they could send their existing Medicare clients to open that door, that start that conversation? What do you recommend they start at?
Yeah. So if you have access to our website, I would
Mhm.
highly recommend going there. There's a products tab at the top, or a forms and materials tab at the top. And then there's actually a full marketing section. It's going to let you pick your state that you're in to make sure we're getting the compliant pieces. It's going to also let you pick maybe specific products if you'd like them. And then we can have product specific ones. Otherwise, we have a full suite of very generic understanding what an FIA is, understanding increasing income, even basic videos on our products. So I'd say certainly lean on me as well if we want any of
Okay.
those digital materials sent. And then we do every year come out with a Social Security and Medicare guide. Very, very popular within the field. It's a fantastic binder. It's very nice quality that you can give off to a client. It's also going to give
Okay.
you kind of space to put in some of the financial workbook information, kind of maybe help build that profile on a client and see if an annuity would also fit after the Medicare sale.
And an agent would go to order those binders under the forms and materials.
Yeah, if you want to order the physical copies, I would recommend calling into our FAST team.
Okay.
I will put their number in the chat here if I can find chat. There we are. But yeah, that would be the best way. Otherwise, you can also call me as well. More than happy to always put these orders in.
Okay. All right. Any more questions?
Yeah. Agents, I know sometimes there's a delay on the Zoom, so if you do have any further questions, please put them in there. But thank you so much for taking the time, brokers, to attend our trainings. This was a great topic. I think it maybe opened, maybe had a light bulb moment for some of our agents.
Yes, especially, when we're talking about they have that money sitting there. Mm-hmm. Why aren't they letting it grow? And that is something that agents tend to overlook. Mm-hmm. They shift to life insurance, but they don't understand that they can go toward, an annuity.
Right.
So.
Absolutely. And annuities can be pretty complicated. So always feel free to use us as a resource here. That sales desk number I put in there, or me specifically, I'm always happy to help out.
Awesome. Thank you. And I guess we should have said this at the beginning. Is there anything specific an agent needs to offer these products with their licenses?
That is a good question. Let me
pull
up.
I didn't even, normally I start with that. Hopefully everyone made it to the end of the training.
Let me see if I can find our piece here. So we do have some more specific qualifications at Allianz.
And while he's pulling that up, agents, put in there what product that caught your attention. Mm-hmm. What product do you think that might be something good for your clients? I think that a lot of times that we, like the ABC, I looked at that one and immediately thought, wow, anytime income, that's huge. To be able to have access to that income.
I got this here. I'll make sure everyone can see that. Okay.
Yes.
Perfect. I know Allianz is a bit more strict. That is a little bit of what we're known for, but there's a few ways that you can qualify. So $500,000 in annuity production, $50,000 in target life insurance. Otherwise, the most popular ones are going to be designations or certain exams that you might have passed. So Series 65 or 66. Any of these designations on the bottom right here are also going to be an automatic qualifier. So beyond production, there are other ways to work with us here.
Good to know. If you have further questions about that, I'm sure Vito will be able to help you. Or Candy. Candy or Vito are definitely here for you if you have further questions on the
Absolutely.
on the details of these products. But thank you again, agents, for taking the time to learn about Allianz, and thank you, Vito, for taking the time to talk to our brokers about it.
Well, so they appreciate the opportunity. Thank you, guys.
Awesome. Thank you, everyone. Have a great day.
Bye.
Bye.